All right, there's a look at what's happening in the markets this morning. So slightly quiet ahead of the Fed decision, but remember, we did see some notable weakness yesterday in New York. April ended with a thud, and the decline was, for the month overall, was the worst we've seen since September. The TSX coming off one of the biggest sell-offs of the year and the largest since February. April ended up being a month of declines to the tune of 2%. Some of the commodities, like energy, have started to lose some momentum, and all of a sudden, we're feeling a little further away from the recent record highs. You add into the mix, you've got earnings to digest. Let's digest all of it now with one of our regular guests, Diane Avigdor. She's a portfolio manager and the head of trading at Barometer Capital Management. Good to see you.
Good to see you too.
I mean, there's a big potpourri, I suppose, of things to focus on. Is earnings or interest rate chatter really driving the tape, in your opinion, right now?
Yes, absolutely.
Yes, okay.
Yes, and yes. It's all, a market has a lot of moving parts right now, so we're in a bit of a funk, and the jury's out as to how we're going to come out. But certainly, number one, I think the market's starting to wake up to the fact that in the U.S., rates are going to be higher for longer. And it's a conflict because on the one hand, you want growth to remain and inflation to come down, and that's a really Goldilocks situation. What holds the story together is earnings, which is we're about halfway through. So markets tend to be idiosyncratic at this time and be a little more volatile. In addition, there is a large systematic community out there that has been extremely long the market, and when the market goes down and hits certain levels, it brings out some selling. So we've seen some asset allocation and some redemptions happening in the market, some selling from this systematic strategies and month-end rebalances. And selling begets selling, so the lower you get, the more triggers you get, and it needs to clean up, especially at a time when all the fundamental investors have their heads down analyzing all these earnings.
Okay, so somewhat mechanical then in nature. And if I look at the last month of activity in Toronto, in New York, tech has been an easy target. I mean, there were a lot of gains already on the table, so you can take those off the table. I guess if there's a reassessment on interest rates, maybe no surprise to see some of the real estate names had been losing some momentum. But even in Toronto, some of the industrial stocks, which had been really strong performers as well, it seems like investors have been looking for areas where there actually were some profits and then taking them. So if you're trying to make a decision on where we go from here after the selling we've seen, what's your best guess right now?
So it's hard to tell where it's going. What we do at Barometer do, we have a very strong, stringent, disciplined process. And my recommendation is stick to your process. Our process right now is, given that our internal indicators are a little bit sloppier, we don't put new money to work. So as money comes in, it stays on the sidelines. We look at what is coming out on a relative strength basis. So, for example, and we enter, we leg in ever so slowly. So, for example, utilities are acting pretty good, and they don't seem to mind the higher rates. So something else must be going on. Maybe it's a little bit of risk off. So we leg in with a small position. We're very mindful of our levels. As stocks come down, sometimes the story is intact, but if they break down, we have levels where we will exit, watch, see what plays out, and then we may re-enter. But we're very, very tactical and disciplined at this time.
Well, let's use sort of an individual stock example, because you had mentioned to our team a stock you like is Nextera Energy.
Yeah.
I guess one of the conversations we've had about the utilities area is that over the longer term, there's a lot of things to like. But I guess when you're sticking to your guns, what comes out with a company like that one?
Right. So this is our first initiation into the utility sector in a while. Like I said, it's exhibiting relative strength. Maybe it's because of something else. Maybe it's because of risk off. Either way, we enter ever so slightly, ever so small, into our favorite. So Nextera invests in the generation and distribution facilities. It also has a smaller component that is in the renewable generation facilities. battery storage projects, and long-term contracts. Pays a dividend, growing that dividend. But it also plays into the story of AI and data centers, in the growth of the need of the data center. And so perhaps that is what's going on. We've seen from some of the tech companies big capex spend. Some of the themes that we've seen in the technology sector earnings is that they're spending more into their future growth. Example is Meta. So we need to develop the grid. There's going to be much more need for that. So those are some of the ideas there.
And I noticed another idea you had was the First Trust New Opportunities MLP and Energy Fund, which I guess that has actually, we'll park that one for now. Let me go back to the Fed, more broadly speaking. Now we've had time to assess the story on rates. And there's still this narrative that Jay Powell might say something that would rattle the markets. Could you see that coming, even though we have come off our highs?
So 2 days ago, we had the Treasury refunding announcement, and that came in with a higher than expected refunding demand or expectation. And that rattled the market a couple of days ago. You saw a big sell-off on that headline and coming back. Since then, there's been some conversation around. So the Fed is doing quantitative tightening to the tune of about $60 billion a month. They're letting bonds roll off. So maybe the speculation is that perhaps they won't do that much of a tightening. We're going to be watching. We don't expect rates to do anything today, but we're very, very watchful as to what Fed Chair Powell is going to say at 2:30. He's been a little hawkish lately, and what happens with the refunding. Just
a final question about tech, how tech performs. Tech stocks generally have come off their highs. We're continuing to move through earnings season. We saw some well-received numbers from a company like Alphabet recently. Is there enough in terms of those who have reported, have they shown you enough that even in the face of some macro headwinds that there's a justification to stay committed to some of them? This is a very volatile sector, and we've gone from the beginning of the year, we were at 30% tech, we're now at 10. Like I said earlier, our process is very disciplined. Some of the earnings have been very good. Google, Amazon, Meta was good, but they're spending a ton of money, so maybe the market doesn't like that. And we still have Nvidia, which is very important to watch because that has been the growth driver in the tech sector. There is enough there to make you hold it, but if it breaks down, this is a very high volatility sector. Other things may take place. We want to be in what's working. We can always go back, and we're a tactical, so we're there now. We'll see. Okay.